Welcome to the My Favorite CPA podcast. Today is November 30, 2023, and we got a subject for you. The IRS just released the retirement plan limits and increases for 2024. And so let's take a look at the new limits. So as you can see, there's been an increase here. Hopefully you can see the screen okay. There's been an increase for virtually every line item ranging from 401k employee contributions to 401k employer contributions. Also, traditional IRA contribution limits have increased. The Roth IRA contribution limits have increased. The SEP IRA contribution maximum has increased significantly. The simple IRA or simple 401k contribution has increased. And HSA contributions and FSA plans have all increased for 2024. So what does all this mean? Let's flip over, if you would. Here, let's take a minute and flip over and do a comparison on different plans that you might consider if you were in business. And then as you look over these, if you would like, comment, share this video, and also subscribe and hit that bell button so you can get notifications of our future podcasts. I'd really appreciate it. But drop a comment if there's something you'd like to hear more about. Okay, so we're going to switch here to a chart where we can talk about the different types of plans that you might consider if you were in business. So this chart is kind of organized from, on the left-hand side, from the simplest plans that you could ever do to something a little bit more complex to something more and more and more complex. More complex does mean higher cost, but the thing to know here is, on the simpler side, it may cost you less, but you can save less for retirement. The more complex and the more expensive that you go, the more that you can save for retirement. So if you were a business owner, this might be, monumentally important to you. So let's take a look here. We'll start in the left column with SEP plans. If you are self-employed, like a sole proprietor or an LLC, an SEP contribution, if you did not have any employees, might be one of the simplest plans you could do. It might be one of the simplest plans you could do, and it allows you to get a lot in. Also, one of the upsides is you don't necessarily have to make a contribution during the year, although you could, but you could also wait until your year is fully over and before the due date of your tax return. If it's only you and you alone as the owner, you could wait until the due date of your tax return, get with your broker, and fund a contribution. That contribution, as we're going to see here on the chart, is tied to your profitability. So let's take a look at that. One of the upsides to an SEP is it's pretty dang easy to start. You cannot have an existing 401k plan if you're establishing a SEP IRA. Then let's look at the employer responsibilities. The way that you start a SEP plan is you fill out an IRS form. It's form 5305 SEP. And then let's look at what administration there is. There's no 5500 form that's required at the end of the year. A 5500 form is something that gets filed, and Department of Labor takes a look at these reports. So now we're involving more government agencies. It's more opportunities to get tripped up. And the fines for not filing a 5500 plan, a 5500 form, if you have a retirement plan, are pretty steep. So anytime we can avoid having to file a 5500 or some kind of annual accounting of the retirement plan by itself, when you're a sole proprietor or a single business owner, let's try and avoid that because life is already complicated enough. Now let's go back to the chart. In terms of the funding, if we have a SEP IRA, the funding of the payment is funded by the employer. Now let's take a look at the annual contribution. With an SEP, the retirement contribution is 100% paid by the company. It is either 25% of the W-2 pay, so that would be if maybe you establish yourself as a corporation. If you establish yourself as a corporation, your contribution to a SEP retirement plan would be based on your W-2, not your overall profitability, but just the W-2 piece. If you were a sole proprietor, by contrast, the contribution would be tied to the profit of your sole proprietorship if you were a sole proprietor or an LLC. So it's either based on your profit or it's based on your W-2, depending on how you're structured. Now, there are some minimum requirements. If you have a SEP IRA, the employee has to be at least 21 and has to have worked at least 3 out of the last 5 years to be able to participate. As far as the employee being able to take money out of the plan, it's permitted, but there are rules that surrounding that. Loans are not permitted with a SEP IRA, but the employee is 100% vested. What does that mean? That means if the employee would separate service, if they would go on to their next job, they get to pick up their SEP IRA that the employer contributed to, take it to their next job, or really take it to their personal account. The annual costs to administer a SEP IRA, because the paperwork is scaled back, it's a lot less. We're talking about big fat none. So an SEP has some pretty appealing things. Let's go back to the 23 and 2024 limits on screen so we can make a comparison here. So if we find the line that has SEP IRA, and I have the capability to circle this. Let me see if I can make this work. I don't think it's going to work on this document. And I just lost my drawing, so let me bring it back up. The SEP contribution limit for 2023 was $66,000, and for 2024, it's proposed to be $69,000. So you could get a ton of money into a SEP IRA, depending how you're structured, because it is tied to your W-2 compensation if you're taxed like a corporation. It is tied to your profitability if you're an LLC taxed as a sole proprietorship or a partnership. Let's go back to my, give me a second here, I want to close this. I don't know why that keeps coming up. There we go. Okay, now let's go on to the next type of retirement plan that we might consider. It's a simple IRA. So if we look at what's the upside of a simple IRA, well, if you have employees with a simple IRA plan, they can put money in, and then the employer will put money in. So if you have a business and you have employees, this is definitely a good one to consider. It's available to companies that have basically less than 100 employees. And you cannot overlay a simple IRA with a 401k. So if you have the simple IRA, you can't add a 401k. Now, as far as employer responsibilities, with a simple IRA, the way you start the plan is you complete one of two IRS forms. It's a 5304 or a 5305 form. Now, just to warn you and give you a heads up, there is a deadline to prepare that form. It's a little bit of an exercise in silliness, I think, as an accountant. But I understand the reason and rationale. The deadline, I believe, is the beginning of October. So sometimes you'll have business owners that want to start this plan, but they're not ready to put money into it until closer to the end of the year. Sometimes those business owners get surprised, shocked, and hamstrung because their broker will ask for a copy of this 5304 or 5305 IRS form. If you were to bring up the form, and I'm not going to do it here, but if you were to bring up the adoption form for a simple IRA, it's a little bit of an exercise in silliness because what you do is you put the company name, ID number, address, and basically mark, I want to start a simple IRA plan. And then it says in the top right corner of the form, do not send this to IRS, which means you put it in your company file cabinet. So sometimes when I've had businesses that have the owner and the owner only, when we talked about establishing this, they buy into it, but they don't get to talk to their broker until past the deadline, and then the broker's hamstrung and says, we can't start this plan because you didn't fill the form out and put in your file cabinet prior to the due date. So if you're going to do this form, make sure that you've done it and dated it right and that it's in your file cabinet before the due date for that 5304 or 5305 form. When your broker asks for it, you can pull it out of your file cabinet and give it to them. Now let's get back to the chart. Funding responsibility, well, you have employee contributions and employer contributions. The maximum annual contribution for a simple IRA, I'm going to flip over back to our chart here again. Simple IRA. Okay, so the maximum deferral for 2023 is $15,500, and the maximum deferral for 2024 is $16,000. So that means that an employee could put in $15,500 or $16,000, which is withheld from their paycheck, and then the employer turns around and gives it to the broker to invest for retirement. At the same time, the company will do some kind of matching depending on what you've opted for under the guidelines of the 5304 or 5305 document. Go back to the chart again. So typically the way the matching works is the employer can match the employee contributions, which would be up to 3% of the employee's compensation. So if an employee puts in 1% of their pay, the employer can match 1%. If an employee puts in 2% of their pay, the employer would match 2%. And if an employee puts in 3%, an employer would put in 3%. If an employee puts in 4%, the company would be limited to 3%. So there's kind of a maximum exposure, which would be 3% of your employee's pay. The other way you can structure the plan is that you'll put in, an employer would put in 2% for all employees, period. Now, when we talk about the minimum eligible employee, so if an employee earned at least $5,000 in any of the 2 prior years, and if they're expected to earn $5,000, that's when it opens the door to the employee participating. Withdrawals and payments are permitted with restrictions, but I want to tell you, you do not want employees with a simple IRA withdrawing money because it can be extremely punitive. I want to say, I'd have to look it up, but I want to say the penalty is 25%. So tell your employees if you're putting money in, plan on it being there for the long haul. Now, again, the plan document is a 5304 or a 5305, which is a form from the IRS. The cost to administer a simple IRA is virtually nothing. Now, let's move on next and talk about the different types of often known as defined contribution plans. So this would be 401ks. The 2 options that we have are a 401k non-elective or a 401k safe harbor match. There is work that comes with both of these 401k plans. And so you're going to see down here at the bottom, your budget for a 401k plan is going to be in the neighborhood of $4,000 a year just to administer it. So once you start the plan without any contributions for employees or employers, you can plan on about $4,000 a year. The way you establish the 401k plan is there's a legal document that's required. We do recommend that you utilize a third-party administrator to make sure you're complying with all the rules, and an annual 5500 form will be required that will be filed with Department of Labor, and they're going to be interested in whether your plan complies with all the requirements. And that third-party administrator, an actuary, will evaluate that for you. The way the employer matching works is with a non-elective plan, there is a required employer contribution of 3% of each eligible person's compensation. The plan would allow for additional discretionary employee and employer contributions. And by contrast, let's look at the Safe Harbor 401k. The required contribution typically for this plan would be a 4% match of eligible participants. And the match would be 100% of the first 3% of the pay that an employee contributes and 50% of the next 2%. It also allows for the employee and employer to put in discretionary amounts. Now let's take a look at the maximum contributions. So I'm going to hold this chart up again. This is the current limits. And so the deferral that an employee can do for 2023 is $22,500 and $23,000 for 2024. So that's how much the employee can put in, and that would be if they are under 50 years old. If they're 50 or over, the employee can put in an additional $7,500. So that is $30,000 for 2023 for an employee that's 50 or over. That's how much they can defer. And for 2024, it's over $30,000 at $30,500. Then, depending on how the 401k plan is organized, the matching in employer contributions could get up to the neighborhood of $66,000 to $69,000 if under age 50, or $73,500 for 2023, or $76,500 for 2024. So those are huge, huge amounts if the plan is written right and if you're using it right. There's a total upside to the amount you could get in a 401k plan. The minimum employee coverage requirements are that the employer must be at least 21 years old and have worked 1,000 hours in a prior year, typically. Now, as far as an employee withdrawing money, they can do that with certain restrictions. But what gets even better about a 401k plan is if it's written into the plan, if an employee comes upon hard times, they can borrow against their 401k and then repay it if that's written into the plan. So that's a huge upside to 401ks if you can tolerate all the paperwork and the extra costs and extra headaches. It's great for employees. And if it's good for employees, that means it's good for employers, oftentimes. It'll help you attract the right people to work in your business. Typically, the vesting in 401ks would be immediate vesting of the amounts employees have deferred. And then for the employer contribution for each employee, that can be scheduled over the plan document. Now, the plan document, speaking of that, you're going to want to budget about $1,000 at the time that you start a 401k plan, and every 5 to 7 years thereafter to update the plan. And remember, you're going to spend about $4,000 a year for one of these two basic 401k plans. Now, Let's talk about one of the exotic variations of retirement plans, which can be layered together with a 401k. And that would be a defined benefit plan. It's kind of, in my mind, I want to say it's kind of a melding of all the plans. If you layer a defined benefit plan on top of a 401k, that's where you can get crazy, crazy amounts in between the limits for the 401k deferral amount that the employees can put in between the employer contributions and maybe profit sharing. That would be layered into a defined benefit plan. So to have a defined benefit plan, you're going to want to be an employer with at least one or more employees. It does require a legal plan document. Again, just like a 401k, it's going to require an annual $5,500. It's going to require an actuarial certification. And the actuary must calculate the annual required contribution. The funding is determined every year by the employer. And with a defined contribution plan, what the company puts in is determined by the employer. Generally, the defined contribution plan must be offered to all employees, or at least 21 who have worked 1,000 hours a year. And you can't take money out of the plan until you hit retirement age. You might be able to borrow against it. The vesting, it depends on how the plan document is written. And speaking of the plan document, it's going to cost you $2,000 to $3,000 when you set it up, and every 5 to 7 years thereafter. As far as maintaining the defined benefit plan, remember, this is one of the more costlier plans to administer. You're going to want to budget in the realm of $8,000 a year to administer that, between all the actuarial calculations and the 5,500 reporting. So when you're looking at retirement plans, kind of to recap, some of the simpler ones are going to be an SEP if you don't have employees, or if you want to be very generous to your employees. A simple IRA if you largely want the contributions to come from the employees, but then you want to chip something in for each employee. Then the more grown-up, more exotic plans would be a 401k. The upside is it significantly increases the amount that an employee can put in, and it significantly increases the amount an employer can put in. And a defined benefit plan, often known as a cash balance plan, would allow an employer to put in crazy amounts. And if it's melded together with the proper plan, a 401k with a defined benefit feature and a cash balance feature, it's kind of the best of all worlds, but very expensive to administer. So let's go back and look at the limits again. When you want to get into the higher limit amount plans, it comes with a lot more headaches, a lot more costs, a lot more administrations. Is it worth it? I think it is, absolutely. At the end of the day, what we're doing is we're deferring. We're taking money out of one pocket, our taxable pocket, and we're putting that money into our other pocket, the non-taxable pocket. These are great, great vehicles to use if you're self-employed, if you're a business owner. Particularly, they work out the best if it's all the owner and the owner's spouse, or the owner and maybe his family members. We're keeping it all in the family, as they say. The things you want to watch out for is all the costs and the deadlines, and make sure that whatever you're signing up for, you have the correct team behind you. I want to tell you a little war story in closing as we wrap up here talking about retirement plans. I have seen some people that have established a retirement plan such as a 401k when they never ever should have, and they did not have the proper team. It's sometimes these plans are pushed by payroll companies where they'll get you into their prototype plan. What they don't tell you, and if you're not informed and don't study things, you do have to make sure that these 5,500 government reporting forms are done. If you don't, the fines for missing it are huge. At my accounting firm, we had an employer just a couple of years ago who started working with us, who established a 401k plan, 7 or 8 years ago, long before they started working with us. We suggested that we noticed they weren't contributing, and we didn't even know that they had a 401k plan until we did some tax planning and suggested let's stuff as much money as we can in a retirement plan. And we decided on using a simple IRA. When we involved a broker with the employer, the broker and the employer started talking, and the broker uncovered that this employer had previously had a 401k plan with one of the big box payroll companies. The broker said, you have to correctly shut that plan down. And here's what I'm leading up to. This is craziness. Get ready for it. Get your seatbelt on. The broker said, make sure all the forms have been filed for all the years. And the employer said, I didn't even contribute some of the past few years, so why would I have to file? Well, guess what? You would have to file because you have the plan. So he said, how do I file? And the broker said, contact the payroll company that ran the plan for you. When he contacted the payroll company, he said, did you file the 5,500 annual reporting? Sure, it's easy. All you have to do is once a year, you have to go in and check the box. When you check the box, we filed that filing for you. This got ugly. He said, oh, I had to go in and do something? Yes, you had to go in and check the box every year. Well, I didn't. What do I do now? Just go and check it for all the years that you didn't file. When that employer checked the box for I think it was 5 years, he did not file the 5,500 reporting. He checked the box, that big box payroll company electronically filed the 5,500. About 3-4 weeks later, in the mail, this employer got fine letters for each of the 5 years he had not filed the 5,500 form. It was crazy. It was $100,000 for each year. He got $100,000 for the 5 years back, $100,000 for 4 years back, $100,000 for 3 years back, $100,000 for 2 years back, $100,000 for 1 year back. He got $500,000 in fines for not filing his 5,500 form. Oh my gosh. He called us Monday morning after he got all these bills. He was a nervous wreck. He said, I'm going to be closing my company. I got to get rid of all my employees. I'm going to be filing bankruptcy. Now, we were able to get him back on track by involving an expert who could help use some special rules that are there for someone that didn't know and that kind of stuff. But man, you do not want to rely on those safety provisions because Department of Labor doesn't have to honor that. They don't have to, if you ask them for permission to blow off the penalty and not pay the penalty, not pay the fine, they don't have to say, yes, we agree. They can say, no, we're enforcing it. And it really could have led him down a bad path. So the war story is this. Don't get involved in something that you don't know the rules on, and don't get involved in something that you don't have the proper people backing you up. This paperwork has to be done every year. If it's not, you're subject to fines. Make sure that you get the right vehicle and you have the right people backing you up. Now, having said all that too, some of these retirement plans are a huge opportunity to stuff money away that is not going to be taxed today. It'll be taxed at retirement. All we know is today. So, and you definitely want to be saving for retirement. So if your company is starting to do well, you definitely want to work with your accountant and your stockbroker to get your company into the appropriate retirement plan. It's about all I have to say today. I would be interested to discuss retirement plan options. I know all of this is confusing, and I know this is a real quick run view. But I want all of my listeners and followers, I want you to know that there are retirement plan opportunities out there. They're huge opportunities to save tax dollars. We use them every day in my accounting firm with our clients. And I want you to know that there are some that are simple and easy, and others come with hooks. And I want you to make sure that you choose the appropriate thing by talking with your CPA, your enrolled agent, and make sure that you have the right compliance team working with you. If you like this podcast today, do me a favor, mash that like button, comment, share this video, subscribe, and hit that bell if you would so you get notifications of our future podcast. Send me a DM if there's other subjects you'd like to hear about. And thanks for listening today. to my favorite CPA.